Welcome to vTalkInsight, Market Drivers Daily for January 14th, 2026. Today matters because geopolitics, growth, and AI are all pulling on markets at once, from oil and defense to banks and semiconductors. Let's start with how a fresh round of geopolitical tension is feeding directly into prices and risk premia. Geopolitics is no longer just background noise. It is directly reshaping the energy complex and trade expectations. The clearest catalyst is the United States threatening a 25% tariff on goods from countries trading with Iran, particularly aimed at large buyers of Iranian oil, such as China, Turkey, and the United Arab Emirates. That move raises the risk of unraveling the fragile U.S.-China trade truce and complicates global commodity flows. Oil prices already reflect a higher risk premium, with benchmarks like WTI and Brent trading above earlier levels as markets focus on potential disruptions around Iran and the Strait of Hormuz. At the same time, there is a record net short position in oil futures, so any escalation or accelerated hoarding by big importers could turn a slow grind higher into a sharp price spike. Energy is not the only asset class adjusting to this backdrop. Industrial commodities are also moving higher as tightness in small but critical materials combines with rising new order to inventory ratios, suggesting increased demand for stockpiles amid political uncertainty. That has helped drive a rotation away from pure technology leadership towards so-called old economy exposures, such as commodities and defense, which have been outperforming as investors price in supply chain and security risks. On the defensive side, gold is being treated as the primary geopolitical hedge, with some forecasts pointing to prices as high as $5,300, supported by central bank buying and efforts to diversify away from the U.S. dollar. Yet the dollar itself is also acting as a haven, outperforming other G10 currencies, especially the Japanese yen, even as U.S. equity futures trade softer on headline risk. Defense and security spending are another key transmission channel from geopolitics into markets. In Europe, rearmament plans are accelerating, with Germany alone planning around $800 billion of defense spending by 2026. Companies like Rheinmetall are responding by building 13 new factories and targeting annual sales of $50 billion by 2030, while acknowledging significant execution risk. In the United States, a $1 billion Department of Defense investment in a missile solutions unit has driven a double-digit pre-market jump in the related defense stock, underlining strong demand for critical weapons programs. At the same time, major defense firms are stockpiling key materials and signing long-term contracts to reduce reliance on China, while G7 nations discuss alliances to counter Beijing's dominance in rare earths. Tensions over Greenland and the Arctic, where U.S. interest has prompted Europe to step up its military presence, add another layer of uncertainty and support expectations of structurally higher defense budgets. Beyond tariffs and defense, the Middle East and Latin America remain pivotal swing factors. Iran faces severe economic strain, with expectations of further currency depreciation and rising inflation, a backdrop that has already fueled domestic unrest. Market scenarios now span from prolonged instability to the possibility of regime change and eventual economic opening, which could turn Iran into a significant frontier opportunity over time, especially for energy and regional trade, albeit with a long and uncertain reform path. Venezuela offers a different but related story. Foreign investor interest is climbing on the view that up to $500 billion could be deployed over the next decade across oil, infrastructure, mining, and tourism, helped by explicit U.S. backing. However, political transition remains fragile. Legal risk around existing contracts with Chinese and Russian partners is high, and the country is a hub for transnational crime. Chevron's entrenched position as the dominant foreign producer highlights both the opportunity and the barrier to new entrants, and underscores why investors still demand a significant risk premium. Layered on top of these regional flashpoints is a rise in perceived institutional and policy risk in the United States itself. Political conflict over Department of Justice investigations into the Federal Reserve and tensions around Fed leadership have raised concerns about central bank independence. Markets see a scenario where if investor confidence in the Fed erodes, bond yields could rise to incorporate a higher policy risk premium, even as fiscal expansion and AI-driven growth support activity. At the same time, U.S. foreign policy has shifted from expectations of neo-isolationism to a much more assertive posture, from sanctions on Iran and renewed engagement in Venezuela to pressure over rare earths and territorial norms in places like Greenland. This is feeding a broader move toward deglobalization and bloc formation. Yet despite this dense risk map, recent geopolitical shocks have tended to have limited and short-lived impact on global markets, with equity and high-yield credit still showing resilience. The key watch points now are the implementation details of the 25% tariffs on Iran-linked trade, any credible threat to shipping through the Strait of Hormuz, concrete frameworks for Venezuelan investment, and how debates over Fed independence evolve. Those developments will frame how much geopolitics can challenge the current growth-driven narrative. The growth backdrop remains surprisingly robust, with a clear productivity-led element supporting the expansion. In the United States, recent data show productivity growth running around 2.4% for 2024, with some quarterly estimates near 5%, suggesting a tangible productivity revolution is already underway. Real revenue per worker for S&P 500 companies has risen about 15% since late 2022, led by technology and communication services, indicating that firms are capturing significant efficiency gains. Early earnings reports reinforce this picture. S&P companies are delivering roughly 14% profit growth on essentially flat revenues, which points to margin expansion rather than top-line strength as the main driver. Looking ahead, U.S. GDP growth is projected to hold near 2% in both 2025 and 2026, with mid-year strength supported by fiscal measures such as tax relief, even as inflation from tariffs has so far fallen short of earlier fears. Fiscal policy and credit dynamics are amplifying this productivity story. The economy is experiencing a notable dual stimulus, the largest fiscal impulse since the Biden-era recession, alongside rapid Federal Reserve rate cuts. That combination tilts near-term risks toward overheating rather than recession. Specific channels matter. Average U.S. tax refunds are expected to jump from about $3,000 to $4,000 per person, providing a meaningful boost to consumption as refunds hit bank accounts. Loan growth is also re-accelerating. Fed data show U.S. bank loan growth rising from around 1% year-on-year at the start of the year to between 5 and 6% now, underpinning a more optimistic view on the banking sector. J.P. Morgan, for example, is guiding toward net interest income of about $103 billion in 2026, significantly above prior expectations and more than double its 2017 level, while capital markets activity and M&A remain brisk after a $5.1 trillion year for global deal volume, heavily concentrated in technology and industrials. Importantly, this growth is not confined to one or two sectors. In travel, Delta sees a 20% profit increase for 2026 and expects first quarter earnings per share to rise by 50%, underpinned by strong corporate and premium leisure demand, even as some travel and cruise stocks have wobbled on concerns over pricing and geopolitics. In healthcare, Dexcom reports a global user base of roughly 3.5 million people, growing more than 20% last year, with penetration of the diabetes market still very low, while rare disease drugs such as Biogen Spinraza illustrate how niche therapies can generate diversified international revenues. Teva is rapidly evolving from a generics manufacturer into a biopharma innovator, with projections that innovative products could generate close to $12 billion in sales by 2035 and multiple data readouts in 2026 spanning schizophrenia, ulcerative colitis, celiac disease, and asthma. Beyond listed markets, middle-market private companies are reporting steady expansion, with recent numbers showing 3% earnings growth and 2% revenue growth year-on-year, and the stablecoin payment space is forecast to grow by a factor of 10 to 50, creating new opportunities for infrastructure providers. Geographically, capital is starting to look beyond the United States, even though U.S. equities remain the preferred market for now. Brazil stands out as a favored story for 2024, supported by stronger GDP growth expectations, easing fiscal and monetary policy, and relatively attractive valuations across financials, manufacturing, mining, and agriculture. In Asia, investors see potential upside of around 15% for Chinese equities, underpinned by estimates of 10% earnings per share growth and room for valuation re-rating, especially if policymakers adopt explicit consumption to GDP or nominal GDP growth targets and curb excess capacity in areas such as electric vehicles, batteries, and AI hardware. Europe could see more of a second-half catch-up if fiscal spending and a possible China recovery support sectors like luxury and industrials, while U.S. high-yield credit is expected to outperform investment grade this year on the back of robust economic activity and AI-related capex, despite the usual late-cycle concerns. The upside narrative is not without important caveats. J.P. Morgan's chief executive has warned that markets may be underestimating risks from persistent inflation, elevated asset prices, and complex geopolitical conditions, raising the specter of pockets of asset bubbles. Consumption growth around 2.5% is running ahead of real labor income growth of roughly 1%, highlighting the role of wealth effects rather than wage gains in sustaining demand. AI-driven capital expenditure is generating fewer traditional jobs than past investment cycles, weakening the multiplier effect and contributing to a K-shaped recovery in which higher-skilled workers and asset owners benefit more than junior service employees. There's also skepticism about the durability of the recent small-cap rally, given weaker profitability and limited resources for AI adoption or supply chain diversification in that segment. Looking a bit further out, some analysts expect the current AI-aided resilience of the global economy to fade by 2026, with China's growth in particular likely to slow as consumption remains subdued and exports face political headwinds, even though headline sentiment on 2026 remains broadly positive. Against this backdrop, key watch points include the upcoming tax refund season, the trajectory of productivity data, bank lending trends, high-yield versus investment-grade spreads, and policy initiatives in China aimed at boosting consumption and rationalizing oversupplied sectors. All of these will help determine whether the current growth acceleration remains orderly or tips toward overheating. Artificial intelligence has moved from a niche theme to a central pillar of both growth and market leadership, with semiconductors at the core. TSMC's latest sales figures came in stronger than expected, and its December quarter revenue rose around 20%, driven by surging demand for AI chips and robust iPhone sales in China, where the latest iPhone model has captured more than 35% market share early in the quarter. Looking ahead, AI chip demand is expected to sustain TSMC's growth through 2026, helped by larger chip sizes, new design wins from players like Google and Broadcom, and the company's strong pricing power in advanced nodes. NVIDIA remains a key bellwether. After a period of valuation adjustment, the narrative centers on its continued pricing power and an upcoming product cycle, including the Rubin Ultra chip, which offers higher memory and GPU counts and improved performance per dollar. Google's TPU is seen as NVIDIA's closest competitor in AI accelerators, but its limited broader market availability and NVIDIA's software ecosystem help preserve NVIDIA's leadership across both hyperscale and enterprise customers. The macro productivity story we discussed earlier is tightly linked to AI adoption. Early earnings show S&P companies delivering about 14% profit growth with flat revenues, pointing to cost efficiencies rather than volume. And AI is increasingly cited as one of the levers behind this margin expansion. Across the U.S. economy, productivity growth has accelerated notably since 2019, with some recent quarterly estimates close to 5%, And there's a view that a broad technology surge spanning AI, semiconductors, and biotech could lift potential growth from around 1.8% to as high as 4% by 2030. Banks illustrate how this plays out on the ground. AI-driven efficiency gains are allowing institutions to grow business volumes while keeping headcount broadly flat, implying that future cost savings may come more from slower hiring than large-scale layoffs. Corporate profitability in the U.S. remains strong as these productivity gains are largely captured by firms, especially in technology and communication services, supporting the argument that AI and related technologies can more than offset the growth drag from trade restrictions and geopolitical friction. AI is also reshaping corporate strategy, capital markets activity, and marketing. Mergers and acquisitions remain robust, with last year's global deal volume reaching a record $5.1 trillion and technology plus industrials accounting for over 42% of that total. Much of it linked to AI capabilities and innovation-driven consolidation among sector leaders. On the primary market side, expectations are high for a strong capital market cycle, with anticipated high-profile initial public offerings and a broader funding pipeline connected to AI infrastructure and applications. Big tech is leaning hard into AI. Apple is reportedly negotiating to pay around $1 billion a year to license AI technology, underlining how strategic these capabilities have become, while Meta is reallocating resources from its loss-making metaverse efforts toward AI products such as its Ray-Ban smart glasses, where stronger-than-expected demand is prompting plans to double or even triple production capacity. Marketing spin tells a similar story. AI and tech companies are now paying more than $8 million for a 30-second Super Bowl spot, and major players like OpenAI, Google, and Microsoft have collectively spent roughly $333 million on U.S. television ads over the past year as competition for mainstream mindshare intensifies. At the same time, the AI build-out is running into real-world constraints around energy, labor, and regulation. AI-driven data center expansion is pushing electricity prices sharply higher in key regions such as Virginia and Illinois, with consumers already feeling the impact. Political scrutiny and community resistance are growing, and there are proposals that tech firms should shoulder more of the incremental power costs rather than passing them on to households. Microsoft has responded by pledging to cover all incremental electricity costs from its data center build-out, an attempt to defuse local opposition and address concerns about AI's energy footprint. More broadly, rising power demand is turning AI from a purely technological story into a climate, infrastructure, and cost of living issue. On the labor side, AI-driven capital expenditure is absorbing substantial corporate cash reserves but creating comparatively fewer traditional jobs, contributing to job market polarization and putting particular pressure on junior roles in service sectors. Public attitudes reflect these tensions. Surveys show that around 80% of people support stronger AI regulation, pointing to rising regulatory risk for the sector, while debates over AI-generated music have triggered calls for licensing frameworks that ensure artists are compensated when models train on copyrighted material. Interestingly, as AI-generated performances proliferate, markets expect live human experiences, such as concerts and sports, to command a growing premium, and the live sports and entertainment segment is seen as relatively insulated from AI disruption in the near to medium term. Globally, AI is emerging as a shared growth anchor, even amid strategic rivalry. Despite ongoing U.S.-China tensions over trade and technology, both economies are expected to benefit from AI-driven advances and enjoy a positive long-term growth outlook through 2030. The AI boom has been a key reason why the global economy has outperformed expectations so far, even as geopolitical risks have multiplied. However, there is recognition that this momentum may fade by 2026 if the return on massive AI capex disappoints, if regulation tightens more than expected, or if energy and infrastructure constraints become binding. For markets, One notable pattern is that recent geopolitical shocks have tended to have short-lived effects compared with the persistent pull of technology and productivity trends, underscoring AI's current role as a primary driver of equity direction. From here, key watch points include guidance from TSMC, NVIDIA, and major banks on AI-related capex and monetization. The evolution of AI regulatory frameworks and data center permitting, electricity price trends in key hubs, and adoption metrics for AI-enabled consumer products and services. Together, these will shape whether AI continues to deliver outsized gains to earnings and productivity, or whether its constraints start to dominate the narrative. Across today's themes, one message stands out. Markets are balancing a rising geopolitical risk premium against a powerful mix of productivity-led growth and AI-driven transformation. Energy markets and defense are on the front line of geopolitics. Banks and corporate margins are showcasing the strength of the current expansion, and AI is simultaneously powering earnings and creating new frictions around energy, labor, and regulation. Watching how tariffs on Iran-linked trade evolve, how productivity and loan growth trend, and how AI capex translates into monetization and policy responses will be critical for multi-asset positioning over the coming quarters. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.